Chapter 16, Real Estate Appraisals. The first thing that I want to talk to you about is the state certified appraiser. Now, this came about by federal legislation, and what it basically says is that if there is a federally related loan that's going to be made, that there has to be a person who is state certified to do that appraisal. So there's a special certification that that person has to have. And it comes through in the state of Florida, Florida Statute 475, Part 2. And as far as a real estate licensee that's not an appraiser, I cannot do an appraisal. So it has to be done by that person, and they have to follow strict USPAP standards in appraising. Now, what that appraiser is going to be looking for is some type of a value. Now, there are a number of type of values that's in the book: investment value, liquidation value, salvage value. But the most dominating value that the appraiser is going to be looking for is something we call market value. And let me kind of just sum this up for you. Market value is what the average persons in a market would be willing to pay for a particular property. And that's the easiest way to put it. It's not just one person, but it's a number of people. And the way that appraisers look at this whole thing is that just because one person is willing to pay, that doesn't mean that everybody else is willing to pay. So what they do is they gather a lot of data that's going to support their conclusions. Okay, let's talk a little bit more about market value and what this is really all about and how we go about deciding on market value. This is easy. First of all, are buyers and sellers both motivated? Are they informed? Do they know what the market is? Have they been given enough time to make a decision? And also, is this an arm's length transaction? Now, let me tell you what arm's length means. The buyer is looking out for the buyer's best interest, and the seller is looking out for the seller's best interest. That's arm's length. And let me tell you what is not arm's length. A mom and dad selling a home to a son or a daughter. That price may not, I can tell you, that's not going to be at arm's length. Another concept that I want to talk to you about is the concept of cost, price, and value. Cost is what it takes to create a parcel of real estate. And that is buying the land, building the building, paying carrying cost. So it's the actual money spent. Value is an imaginary number that we think it's worth. And that's what the appraiser's job is. And actually, it's our job too when we do a comparative market analysis. It's what we think it's worth. Price, on the other hand, is what somebody's actually willing to pay for it. Writing a check. Now, those three things may be similar. They may be identical. But be assured that one does not create the other, depending on the market. Because just because it costs $200,000 to build a home doesn't mean you're going to sell it for that amount. In a bad market, it may be less. In a good market, it may be more. There are a number of principles that we need to look at. First of all, let's take a look at value. And how do we determine what value is? There's an acronym. It's called DUST. Value has to have, first, demand. It has to have utility. There has to be some scarcity, and in real estate, it has to be transferable. So DUST is the acronym on that. In addition, when we talk about the principle of substitution, all this simply means is that every parcel of real estate, every property can be substituted by another. And I think the basic theory is that if everybody's paying this amount of money for the same property, why would they pay more for yours? That's the principle of substitution. Your property can be substituted by another property that's either just like it or very similar. Remember, we also talked about highest and best use. Remember, highest and best use has to do with what can we do with a particular piece of property that's going to cause it to be either worth the most money to us, or what's going to cause it to generate the greatest net income to us, what's going to cause it to be the most valuable to us. And I want to also talk to you about the difference between assemblage and plottage. Assemblage is combining parcels of real estate together under one ownership. Plottage is an increase in value because of that assemblage. Let me give you a good example. A number of years ago, I did a development project. It was Gulf Coast Medical Arts Complex in Pensacola. I went in and purchased 11 separate parcels of real estate. That was called assemblage, and we put it all under one ownership. When I originally purchased it, we paid $1.25 a square foot for all that land. It was about 9 acres. Once we got our development order, we got our plan put together, we went back into the bank and had it reappraised for our loan. When they appraised the land after that assemblage process, they gave us a value of $3 a square foot for the land. Well, what happened to the value of the land? It almost doubled in value. In fact, it did more than double in value because of that assemblage. So if we can increase the value of the property through assemblage, that increase in value is called plottage. There are 3 approaches to value real estate: the comparable sales approach, the cost depreciation approach, and the income approach. So let's start with the comparable sales approach. The comparable sales approach is simply taking comparable properties, looking at them, matching them up, and saying that our subject property is worth X amount based on what we see with these comparables. Now, what are these comparables? They're properties that are similar, and as similar as possible as we can get. This is based on the principle of substitution. And we rely very heavily on the comparable sales approach when we're appraising residential property, vacant land, and small income producing properties. So what we'll do is we'll gather a number of comparables. We'd like to get somewhere between 8 and 12. And we're going to look at them. And if they're not identical to our subject property, we're going to have to adjust those and make them like our subject property. And so, for instance, if our comparables are 4-bedroom and our subject is 3, we got to make that comparable a 3-bedroom. That means we have to take away from it to make it a 3-bedroom. So we always will adjust the comparable up and down to try to make it match our subject property. Here's a good way to remember the comparable sales approach. Robin Hood: take from the rich, give to the poor. If the comparables are a superior property, a better property, got more things, you take away from them. If that comparable is inferior, in other words, it's not as good as the subject, we have to add those things to it to make it like the subject. Take from the rich, give to the poor. Then once we get all of these done, then we're going to reconcile that and figure out what the value of our subject is. The next thing that we're going to look at, or what the appraiser looks at, is going to be the cost depreciation approach. Now, we're not going to use comparables here. This is going to be based on something totally different, typically the cost per square foot. And what we're going to do here in the cost approach is we're going to separate the building from the land. The land does not depreciate. It's the building that's going to depreciate. And there are several ways that I'm going to show you how it depreciates. But if we don't have any comps, we're probably going to rely very heavily on this cost approach. So when we're dealing with special purpose type buildings, this approach is going to come in really handy to help us find out what our property is going to be worth. The first thing that we've got to do is determine reproduction cost. How do we determine that reproduction cost? The first one is going to be the unit comparison. That's the most common, and that is asking what would it cost per square foot to build this building brand new today. Well, obviously this building is not brand new. If it's got any use to it at all. So the second thing we've got to do is, what is the amount of depreciation? Well, there's 3 categories of depreciation. Physical deterioration, which is ordinary wear and tear. Functional obsolescence, which is a design problem. Give an example: 3-bedroom, 1 bath. That's the design problem. And then the last thing is an external obsolescence. Our property has lost value because of something around it, something off-site, something that we have no control over. In fact, external obsolescence is almost always incurable. And if you were to say what's the difference between curable and incurable, anytime that you can add something to a home or repair a home and you can make money, that's curable. For instance, paint, for every dollar you spend on paint, you typically get back $5 in value. For every dollar you spend on landscape, you typically get back $3 in value. But anytime you repair or add something to a home and you can't get all of your money back, that's incurable. Insurance companies will tell you that for every dollar you spend for major renovations of a kitchen or bath, you typically get back 60 cents on the dollar. Well, you don't get back all of your money, but you get back most of it. That is incurable. And when you're looking at the cost approach, what we have to do is separate, and we have to say that every property has an economic life. What is that? 40 years, 50 years? And then we have to say that because of the depreciation, it has an effective age. The effective age is based on depreciation and also maintenance. And so if we can subtract out that effective age, that's the loss. So everything beyond that, for instance, if the building has a 50-year economic life and the building looks like it's 10 years old, that's the effective year. That means that 10 years out of 50 has depreciated. That means you have 40 years out of 50 remaining, or 80% of that reproduction cost. The last approach to value that the appraiser is going to use is called the income approach, or the income capitalization approach. And in this approach, all we're saying is that certain income streams have value. Now, this is going to be based on the IRV formula, I over RV. The I, the income, is called net operating income. Now, let me show you how we're going to get down to net income. The very first thing we're going to do is determine the property's potential gross income. And that's going to be determined through either market rent or contract rent. That's the maximum that the property can possibly generate under the very best terms and conditions. Well, not all buildings stay occupied 100% of the time. So the next thing we want to do is subtract out vacancy and collection losses. Once we subtract that out, that's going to give us something called effective gross income. The effective gross income is the real money that we have to pay our bills with. Once we've calculated our effective gross income, the next thing that we want to do is calculate all of our operating expenses. Now, our operating expenses are going to fall into three categories. Fixed expenses, those are items that are going to be there whether it's occupied or not. Those are taxes and insurance. The next category, variable expenses. Those are items that will fluctuate with occupancy, maintenance, management, and utilities. And the third thing is reserves for replacement. We want to put money aside to pay for things that break. Those are our three categories of operating expenses. I think it's important for you to remember that your mortgage payment or your debt service is not an operating expense. Now, what we're going to do is we're going to take our effective gross income, subtract away all of our operating expenses. That's going to give us net operating income. The appraiser is looking for the net operating income to be able to find the value of the property in the IRV formula. I over RV. The I is net income. And when you divide that net income by a cap rate that the market tells us that is the general cap rate, it's going to give you the value of the property. I over R equals V. Another way of determining value that the appraiser uses is something called the gross rent multiplier. I call this my Vroom formula. Value, rent, and multiplier. Now, the difference between the two, the income capitalization approach is based on annualized information. The gross rent multiplier is a monthly calculation. The income capitalization is based on net income. The gross rent multiplier is based on gross income. And the Vroom formula, V over RM, value, rent, multiplier. If you know what the monthly gross rent is, and if you know what the market multiplier is, multiply the multiplier times the rent, and it'll give you the value of the property. Real estate licensees are also going to have to be able to do the comparative or competitive market analysis. It's a CMA. Now, typically speaking, we do this as part of a service of real estate. Now, can you charge somebody for it? Yeah, you can. It's not practical. So what is this CMA? We're going to try to determine what a property is worth in a real estate transaction. It's not an appraisal. We're not allowed to do appraisals. But it is similar to an appraisal because we're going to be looking at properties that are currently either sold, on the market, or that expired. So the three properties, and here's why we look at them. First of all, properties that have recently sold. That's going to tell us what the market is willing to pay today. So we look at sold properties first. Then we're going to look at properties that are currently on the market. That's going to tell us what our competition is. And what we don't want to be is above our competition. And lastly, what we're going to look at are properties that have expired. And those properties that have expired tell us that the market is not going to pay that, so we don't want to list it at that price. Those are our three components of the comparative market analysis. And there's a little case study in here that I'd like for you to take a look at to make sure that you know how to operate it. It even has the answer key for you. And that's all I'm going to have for you for Chapter 16 on the appraisal section. So what I want to do right now is I want to go ahead and review this section with you to make sure that we understand what those areas of critical concern are. Chapter 16 review for the appraisal section. An appraisal can only be done by an individual that is state certified. The real estate licensee can prepare a CMA. Market value is what the normal buyer under normal conditions would pay for a property. Cost is the actual money spent to buy or create a property. Cost, price, and value may or may not be the same. The comparable sales approach, remember Robin Hood, take from the rich, give to the poor. If the comparable is better than, take away from it. If the comparable is inferior, add to it. The cost depreciation approach, remember we rely very heavily for special purpose type buildings where we don't have comparables. The income approach, you're simply taking net income and dividing it by cap rate, giving us value. And this is based on the principle of anticipation. Assemblage is combining two or more parcels together under one ownership. Plottage is increasing its value because of assemblage. In the comparative market analysis, we're going to look at sold properties. We're going to look at properties that are currently on the market. And we're going to look at for those properties that are expired. The principle of substitution sets the upper limit of value. Land is typically valued using the comparable sales approach. The gross rent multiplier is your monthly gross rent times that multiplier gives you value. In the income approach, we're going to take net income divided by a cap rate, which is going to give us value. Remember, gross income minus vacancy gives you effective gross income, minus your operating expenses gives you net income. And that is the end of the review for Chapter 16.